take us through the next part. So Jamie's going to talk about three things: carbon, renewable markets, and I might chip in from the peanut gallery. But if you have thoughts or something you want to add or question, feel free to be interactive.
Thanks everyone for coming. Tonight we're going to cover three sort of areas of the renewable energy conversation. To begin with, we can't talk about energy without talking about carbon. So we're going to talk a little bit about that. We're going to talk about the current renewable energy markets, primarily wind, solar, biofuels, and geothermal. Nuclear and hydroelectric are part of the conversation, but they have their own set of questions and concerns, so we're really going to focus on this area of renewable energy. And then how do you take that information and build a hip energy portfolio? So we've all heard the carbon story by now. It's the highest it's been in 650,000 years. It's going up and up and up, and it's wreaking havoc on our planet. Increased storms in some places, drought in other places. Those things cost human lives as well as a ton of financial impact. Why is carbon such a problem? This is a chart of our global energy use. 67% of all global energy comes from fossil fuels. Just 3.4% comes from renewable energy sources. Part of the reason behind that is that the fossil fuels are incredibly cheap. Coal is a huge carbon emitter. It emits 20% of all greenhouse gases in the world. The United States has 51% of its energy comes from coal, and China, 80% of its energy comes from coal. For some perspective, China is adding 6 new coal-fired power plants each month. Right now, coal is so cheap that it's hard to have the same conversation with solar. It's a couple cents per kilowatt hour, where solar, you can see, is over 35 cents per kilowatt hour. But that could change if we start having to pay for carbon through regulation and tax policy. Cost of coal, oil, and gas will go up. Solar and other renewables will come down. So solar is a hugely important component of the renewable energy landscape. And this is a map of the solar radiation in the west of the United States. And it looks pretty good as far as creating solar.
And if PG&E were here, they'd talk about this big installation going into the Mojave Desert, right in that middle red spot, with a mix of concentrated solar thermal plants. A 553 megawatt facility, which is the size of a large coal facility, say.
It is good news for the price of solar and other renewables to come down because the policy around the world is changing. There's policy targets for renewables in 66 countries. All 27 European Union countries have policies regulating carbon emissions. 29 states, including California, and 9 Canadian provinces. Both presidential candidates support some form of carbon regulation. Unfortunately, this week, the Climate Security Act was shot down in the Senate, though supporters of it claim it will resurface in 2009 under a new administration. So that's good news. And an interesting study came out recently from Tufts that actually addressed what it would cost not to implement the Climate Security Act. And it showed that it would cost a loss of 1.8% of our gross domestic product in the next century. So that's a good thing, hopefully, for persuading both sides of the House and the Senate to pass this bill. So in talking about carbon and the price of carbon, there's a huge variation on what people believe it will cost. Currently, there's a voluntary exchange, the Chicago Climate Exchange, where it's trading for about $7. And there are a number of companies, large carbon emitters, who are partnering with low carbon emitters and trading offsets. And those are trading between $8 and $20. And then the European Climate Exchange, which is in an environment with much more regulation, addresses 20 to 30% of carbon in Europe in 4 to 5 industries, and it's trading for around $43. In a little while, we'll hear from Tara Passon. I think Jay will be able to address the carbon trading a little more effectively.
And I'll just chime in one thing here. So in the U.S., you might be familiar with something called weather futures. So you can actually bet on what the weather will be certain degree days. And the weather futures market is actually pretty developed in the US. It's not so developed in Europe. Whereas in Europe, the carbon market is more developed and weather is not. But they correlate together. So from an investor perspective, as you're trying to think about how to build a diversified portfolio, you may want to consider carbon future and trading carbon in Europe and trading weather in the US. And there may be some approaches you want to take in your portfolio to diversify around that. And I better speak up here, since this was an analysis we actually did in talking to an insurance company who wanted to know, well, how much profit is at risk? So what we did, and we did this as part of the Fast Company analysis too, was look at the greenhouse gases related to equivalent barrels of oil for large energy companies, and looked at what their rates were. So Marathon, which is an oil refinery, is very efficient, more efficient at carbon than others in the industry. Exxon and the Italian company Eni, very less efficient. Some of that's structural around the types of businesses that they're in. But what this shows is anywhere from 7 to 19% of the profits at risk if you believe carbon is worth $20 a ton. If you believe it's worth $40 a ton, then it's twice that amount. If you believe it's worth 10 times that amount, like $200 a ton, like whoever thought of $140 barrel oil, then it might actually wipe out profit. But in today's market, it's obviously a material effect, but it doesn't put the companies out of business. And when you compare it to the amount of subsidies that oil companies get, and oil companies get more subsidies than renewable energy companies get subsidies, it makes for a very interesting analysis.
So what are measures of efficiency?
I'm sorry, the measures of efficiency in terms of greenhouse gas efficiency?
Yeah, you're talking about differences in efficiency between companies.
Yeah, so ExxonMobil, for example, has a big chemicals business. And so chemicals have a high multiplier effect because they put off methane and perfluorocarbons and other things like that. So they have some structural parts of their business, not unlike Shell does, whereas Marathon is a pure oil refinery and has started diversifying into biodiesel. And things like chicken fat, partnership with Tyson Foods.